Joining me now, founder and CEO of Market Compass LLC, Amelia Bourdeau. Amelia, good to see you this morning. It doesn't look like we're going to get any relief in terms of the trade tensions and fight between the United States and China. What's going to drive markets this week? If we get good news, say, on retail sales, good news like a very tame consumer price index, will that help give markets a lift?
I don't think it'll help that much. What's happening here, and this happens once in a while, these big global macro issues come up, and these big global macro themes like China trade tensions, like Brexit, like Federal Reserve inverted yield curve, they tend to dominate the market. So any little readings you get in between, which are important, retail sales, CPI, they're just dominated by these larger financial market themes. So macro themes are asserting itself, and what you really have to do here is kind of prepare for a really volatile and continued market. So you want to look towards safe haven assets to manage your portfolio.
Amelia, good morning. Mitch Rochelle. One of the things that's a macro issue is how our currency is rising at the expense of other global currencies. And I'm curious to get your take on that and how that could continue to disrupt global markets and maybe the balance of trade wars aside.
It's interesting. What people have to remember, though, even though the Fed is cutting rates, bond yields are clearly falling in the United States. They're also falling around the world. The dollar is a safe haven currency. So in times of market stress, which is now, people investors tend to flock to safe haven assets, bonds, US dollar, gold, Japanese yen. So you're seeing that we're not going to get away from that strong dollar, even if the administration would like us to, because we're the strongest economy in the world still, and people have a flight to quality for assets. So the dollar is going to be strong even though the yields are lower.
One thing that Amelia, have tried to illustrate for the viewers is that when you have bond yields plummeting the way that they have been, and with the steep slide last week, now granted the 10-year yield is not at the record low of 1.3%, but when you have this happen and you have, as Mitch has discussed, $15 trillion in government debt around the world with a negative yield, do we really even know what this does to the global economy? Because again, it really turns the world financially upside down, where in essence you have to pay to lend an entity money.
Yes, it's very troubling. I think what was the most troubling last week about the moves in the bond yield is the speed, the sharpness at which the lower rates came. It was pretty unexpected when it came, and again today the slide further to below 1.7%. So we have to watch the speed of the moves. It does come back and forth, so it matters the duration, the time length that we stay under, we haven't reached that 1.3% yet. Were we nearing the 1.3%, I think you would see even more, as you point out, dislocation in global financial markets. We're still a ways away from that yet. It doesn't mean we can't get there. It doesn't mean we can't get there quickly. As I said, the bond yields, move really quick. We're only one tweet away from the administration, perhaps, for bad China news from that happening. But that's why we really need to go into your safe haven assets right now. It doesn't have to be the majority of your investment. It can just be a hedge on your overall portfolio, because you're right, global market dislocation is here and it's going to continue. I mean, October 31st is a Brexit deadline, and they've made no progress so far into that deadline. That's a huge risk for the markets, and coming up even sooner, September 1 is when those tariffs from the administration are going to be implemented on China, and so that's going to hit markets as well.
Amelia, good to see you. Amelia Bourdeau.
Good to see you.
Bourdeau, sorry. I'll get it right after 80 tries. Thank you so much, Amelia.
Thanks for your time.
Yeah, absolutely.